We have with us Feroze Azeez, who's the joint CEO at Anand Rathi Wealth. Gentlemen, good afternoon. Thank you so much for joining in. Well, every day is a new day in the kind of environment that we are in. And in that case, it does impact investors. It does impact first-time investors who are just starting into the market and seeing so much up and down, right? So normally, what are the top 3 mistakes that you see that retail investors make in a volatile time like this?
Feroze, firstly, anything you would like to add on to that? Any other mistake that an investor should avoid? And what if an investor is holding some cash on the sidelines right now? Like Tarun was saying, right, we're seeing a fall coming in. There is a discount coming in right now. Is it the time to look at it? Maybe lump sum investment. Is that a strategy that one should look at as well right now?
Good afternoon, Vinnii. There's quite a few things on this topic we can discuss, but I think panic selling, like Tarun said, is one of the biggest mistakes people do, stopping their SIPs. But before that, panic selling, I would say volatility is actually very low. I don't know where this narrative comes from. Volatility is high. The standard deviation of Nifty is 11.72 on an Excel sheet. If you put the closing values of Nifty on an Excel sheet and calculate standard deviation, it is for S&P 500, which is 500 stocks, is 18.65. And for Nifty, which is just 50 stocks, is 11.72. This is the third least standard deviation in the century. There are other two where you have seen 9 standard deviation, which was calendar year 9.56 for calendar year 2022. And calendar year 2017, the Nifty threw up a standard deviation less than 10. And these 2 years were very positive years. This is the least standard deviation and a negative year our market could have ever shown, and 600 bips lesser than S&P 500. If you see the total drawdown of Nifty after all this catastrophe from August 1st, when Trump announced 25% tariff, another 25% tariff in the same month of August, Nifty is exactly where it was. The biggest man in the world has been after our capital markets, and still you see no correction on Nifty. FIIs sell 1,66,000 crores, which is the highest ever, and you still your puts never get exercised in the money. Think about the bear who's buying puts from August, hoping for a correction and paying time value of money. Not even once has it got exercised in the last 7 months, and volatility is the least. Unfortunately, today is a social media world. You'd read more than you actually have, right? People might one aircraft moving from US to the Middle East can be projected as a nuclear war, almost going to happen with a 20% probability. So I think more news, more information, lesser volatility. And lesser volatility, mathematically, let me tell you, Vinnii, December puts are the cheapest ever I have ever seen being on a derivative terminal for 21 years. So that's one. Okay. Panic selling, please don't do. People will send you, you will read newspaper articles of 15,000, 17,000, 20,000 on Nifty. People would not even have looked at the top 10 stocks. What is the value they assign to Reliance, HDFC, ICICI, Axis? All these are top 10 stocks which cover 64%. People project numbers without even going into the second decimal mathematics. So no panic selling, no stopping SIPs. Don't be recently biased, by which I mean don't look at only data of today. People forget 13 years of underperformance or negative return of silver with 6 months of great positive return of silver and go and buy it at 120. Ironical to see maximum inflows in ETFs of gold and silver at the peaks of 5,600 and 120 on the dollar terms I'm speaking. So no recency bias is the last message.
Feroze, your thoughts on this as well, right? Today also we did have that AMFI data which came in, Flexi-cap funds leading the way over on the hybrid strategy. You know, would you say Flexi-cap maybe is the way to go at a time like when you're seeing a correction in the market? Or what are your thoughts in terms of large mid-cap funds? Where should the investment start with?
Vinnii, in my judgment, or Anand Rathi Wealth Limited, we calculate the fair value or the fundamental value of all these 3 indices. Mutual fund investors should be concerned about only these 3 indices, which is the Nifty large cap, Nifty mid cap of 150, and Nifty small cap 250. There are several small cap and large cap indices or mid cap indices, but these are the 3 which are relevant because these are the tier 1 benchmark for mutual fund. We calculate the fundamental value as per us. What should it ideally be? Of course, give or take, there is tolerance to that computation. If I see the markets or the index level lower than the fundamental level, which we think is a fair price, then I would be attracted towards that segment. Now, let me put some numbers. The fair value of Nifty small cap 250 in our judgment could be as high as 19,680 at a valuation of about 26, 27 P, which is what small caps have commanded on a median basis. So there is a negative froth of 20%. So small cap seems attractive. It takes a little more courage to invest, but I think you should invest in small caps, 20 odd percent, 25% in mid cap and 55% in large cap is what our current Anand Rathi mutual fund model portfolio possesses. Large cap also Nifty has a negative froth of minus 5.5 and Nifty 100 has minus 6.8 and Nifty mid cap has minus 10.7 froth, by which I mean valuations are cheaper than what the median valuations should for these respective indices. Flexi-cap definitely gives the mantle to the fund manager. So a retail investor definitely can choose Flexi-cap because the flexibility is fund manager's responsibility. So I think the retail and the mutual fund investor is doing the smart thing of allocating more money, like you said, Vinnii.
Feroze, let me begin with you this time because factor funds like momentum, low volatility, quality, they have gained traction. So in a correction, which factor historically holds up the best? And do you think this could be a time to maybe add some factor exposure to your portfolio?
Good afternoon, Sonal. I think when it comes to factor investing, of course, there are several market situations where some of these factors work. In my judgment, value will work better because if you see Sensex over the last 45 days has underperformed Nifty by 1.3%. It has not happened in the recent past, or at least I have not observed in my last 20 years where I observe every day. Whenever Sensex underperforms Nifty, it implies that the larger stocks have underperformed. 1.3% underperformance. People are not talking about it. Nifty and Sensex have 30 stocks, of course, in common. But others 20 stocks, the broader market stocks have done better than the top market. So I think value in large cap can do better. That's my perspective. Then comes, of course, factor investing is good, but in the current situation, I personally think broader themes, diversified will do better. I have a list of 17 FIIs, which I did some research and figured out the most short-term FIIs. These 17 names, if extrapolated of what is their ownership in NSE small cap 250 stocks, it is one of the least. Whenever these 17 guys are there is going to be that stock is very, very volatile. So what am I trying to get to? The frothy ownership of small cap is behind us. There is a lot of index fund ownership in small caps than frothy ownerships. So your risk to reward ratio is higher in small caps itself. So I think a large cap portfolio on the value side. And when you're participating broader market, don't go for factors, go for the broader funds. Diversified is my judgment.
Okay, take that point. Feroze, very less time left. So if you can quickly tell us what is this one fund category you would avoid completely right now and what would you replace it with?
I would avoid all sector funds currently because the broader market provides more opportunity. You have to not go top down, you have to go bottom up in the market we are. And I think the last important message, Sonal, is that the SIP numbers, again in the Amphi data, show 29,000, a 3% reduction. That's not an actual 3% reduction. In February, you have a number of days which are lesser, is why you see a dip. But actually, if you normalize it to 30.6 days, which is what the average month has, there is still a 1% growth in the SIP number. Retail has behaved far more rationally than even HNIs have over the last couple of years.
Absolutely, they have behaved far more well than HNIs have. And SIP numbers surely, they have maintained that steady flow over the last few months as well. So not much of a worry coming in here. Feroze as well as Tarun, thank you so much for joining us on the show this afternoon.